business basics, and we're going to apply these to liquidations and arbitrage and pallet flipping and things like that. This is the first of the weekly series. Going to talk about a subject that gets a lot of people in trouble. It's something that could potentially cause you large fines or even jail time. What I'm talking about is something called commingling. Commingling, at its core, means that you are mixing your business and your personal assets. Okay, so it's the simple example of this, and the one that gets people in trouble all the time. You go to an online site, you find a pallet or a lot that you want to buy, you write them a check out of your personal account, or you use a personal credit card to purchase it. That is, you are already in trouble. You're already commingling because you're using personal funds to buy things for the business. Now, that works on the other end of the transaction as well. So you take the things that you sold, and the money goes into your PayPal account, and you transfer it into your personal checking account. Okay. Well, what's just happened is that the business's peanut butter got in your personal chocolate. It's the Reese's conundrum. You've taken something that's personal and something that's business, and you've mixed them together, and that's commingling. There are large fines that the IRS can impose on you for doing that. It's potential jail time for tax evasion. And depending on what it is, I mean, they can be pretty big. So you definitely want to avoid doing that. But the part that gets people in the most trouble is when you're not talking about money. Most people that are starting a business find out very quickly that you don't mix your personal money and your business money. What you do is you make a personal loan to the company of the initial amount to get started in return for 100% of the shares in that company. So you create a company, and we're going to talk about why you should create corporations or LLCs in another video. But you take your personal funds that you're going to invest, you loan them to the company. Okay? The company then uses those to open their PayPal or open their checking or whatever kind of account it's going to be, and to fund that account. Then your purchase of the pallet or the lot or whatever it is you're buying, the business does it with its own money that it borrowed from you. And then when the business brings the money back in, after you've sold whatever it is, after you flipped it, the money that comes back in, you use to repay that debt to yourself. That's how you get the money back from the company to yourself. And that all happens without any tax implications. Now, obviously, once you paid that loan back to yourself, and the company is no longer owes you money, the company can then give you an income, and that becomes regular income. It's taxed at your regular tax rate. So commingling, the money part, most people get that kind of sort of right, and the IRS isn't real bad about it until you start talking about, money where you're talking in the $5,000-$10,000 range. Then they start to get a little antsy about it. The one that gets people in trouble longer term, though, especially in an industry like pallet flipping, the one that's going to get you in trouble in the most sneaky way possible is when you take something from the pallet for personal use. So think about this. You got a pallet, you got 200 items. The pallet costs you $200, so it's $1 an item, right? And there's something in there you're not going to be able to sell it, or it's just something you really want. Like you saw in one of our pallets, Ben had an upcoming graduation for his daughter. There was a thing of graduation props in there, and he wanted it. And if he had just taken that and not paid the business for it, effectively the business would have been gifting him that item, which turns it into either regular income or capital gains, depending on it. So let's think about that, and let's blow it up into the grandest possible scenario. Okay, so the business does really well. You're 5 years in, you're making $100 million a year. The business buys a $33 million mansion. I picked that number because I just saw it in a video somewhere. $33 million mansion, and then signs the title over to you. Well, guess what? You now have to pay your taxes on that capital gain. In the business, and you are in serious trouble with the IRS if you don't. Well, the same thing applies on the smaller level. If you have something that's in a pallet that you want, you have to pay a fair value for it. In other words, you can't just say, here's $1 for that $33 million mansion. You can say, well, the business only paid $20 million for it, and I'm going to give it a reasonable amount of profit, so I'm going to give the business $21 million, and that mansion's mine. That's legal. That's fine. There's no problems with that at all. It's when you take something out of the business that you're not giving the business fair market value in return. That is commingling. It's the items that you buy on pallets, those are assets. And if you mix your personal and business assets, you can get in a lot of trouble. So don't do it. And I want to be very clear. I'm not an attorney. I'm not an accountant. I'm certainly not a CPA. These are basic business principles, and oftentimes they get missed, especially when somebody's doing their first business. I will tell you flat out, I was guilty of commingling in my very first business. Oh, I was so guilty of it. There was no business. I didn't even bother to set up a business. I was doing work and I was receiving pay, and the pay was going in my bank account. I did pay income tax on it, which is what kept me out of trouble, but there is no doubt in the world that I was commingling. And eventually I did get out of it by breaking up my accounting and saying these are my personal things and these were the business things, and doing all the math to make it right and accounting for it properly. If you have questions about that, by all means ask your attorney, ask your accountant. The key here is do not take your business things and your personal things and mix them together. Now, there is one good thing that comes out of this, and again, not an attorney, not an accountant, but I've been doing businesses for a while, and that is you can take an area of your house or your apartment and section it off and say this is a business area only. So for example, my office has all of my business computers in it, and I have a server room in my house for my servers for the business. Every year I can say this area that I have sectioned off that is only used for the business is X% of my house. It's 10% of my house. And so therefore, whatever I've paid in mortgage or capital the capital gains I've made if I don't have a mortgage, the rent that I pay on the apartment. Let's say I have a 3-bedroom apartment and 1 bedroom is solely dedicated to storing my stuff. I can take that 1 bedroom and say this is 200 square feet out of my 800 square foot apartment, or whatever the size is. So if it's 200 square feet out of my 800 square foot apartment, 25% of the rent that I pay, I can write that off as a business expense because it is used solely for the purpose of business. Now, the minute I go into that bedroom and I store a stuffed animal that my kid wants, it's no longer solely business use. It's no longer able to be written off. So it works both ways. The biggest takeaway is that the best thing you can do is never mix the two. Go to the bank. You only need $100 to open an account in just about every bank that I know of. Go up, open a $100 account, loan your business $100, open a business account. You'll need a tax ID and all that stuff for it. And we'll talk about the corporations and how to incorporate in a future video. But go open that account for $100 in the business name. Make sure that all of your payments go out of that and all of your receipts come back into that. All of your accounts payable go out of it. All of your accounts receivable come into it. and then distribute the money from there and do it in a way that's consistent with tax laws. That's how you stay out of trouble, and more importantly, that's how you stay out of jail. So, just some thoughts, short video. First business concept, commingling, taking business assets and personal assets, mixing them together, there is potential outcome from that financially and personally, so don't do it. Thanks, have a great day, and we'll see you next week.